Chris Vermeulen is back. He's the chief market strategist at thetechnicaltraders.com, and this will be my final interview for 2025. A sweet, bittersweet farewell to the year, and who better to ring off the new year than Chris Vermeulen? Welcome back to the show, Chris. It's good to see you, Chris.
Hey. Yeah, thanks for having me, David. Always a pleasure, and Happy New Year.
We're going to be getting Chris's outlook for the year, his best assets for the coming new year, as well as possibly the worst assets to come. Let's start with silver and gold. I want to start with the metals today, a little bit out of our usual rhythm, Chris, and the only reason I'm doing that is because silver has had a monumental run in the last week, running up to $80 and then falling, I think, double digits, 15 to 16%. It hasn't fallen this much in a single day intraday trading session since, I can't remember the year, but it was a long time ago. So this very sharp rise to 80 and then a very sharp reversal back to 72. I mean, it's still high, right? It's still like 72, but the quick reversal, that was a scary drop. And now silver is stabilizing around 75. So big green candle, then a big red candle, and then a smaller green candle is what I see on my screen. I'll let you share your screen and walk us through what you're looking at here.
Yeah, well, there's definitely been some pretty amazing moves in the precious metal space. I think all of us have been waiting years for everything, especially silver, to really pop. And of course, silver has done that. As you just mentioned, if we look at the last three candles that we've seen, we saw like a 11% rally one day, then a massive reversal. We actually had $82 as my kind of blow off spike high, and we actually hit $82.50 just 2 days ago, and then it sold off fairly dramatically, and now we're getting that bounce. So there's a lot going on. It's not just in silver, it's in the whole precious metal space. You and I have touched on this, that when you look at the comparison of 2007 and what miners have done, what platinum and palladium and silver have done, we're definitely seeing everybody starting to really move into this space who wants to get in. And it is starting to feel really frothy. As exciting as it is, and people think it's just getting started, the charts are actually showing signs that it's actually starting to become exhausted. And this type of red bar, that is a pretty scary red bar, is one of those signs that we're getting close to maximum kind of volatility and some type of blow off top. Now, there are reasons for this. We saw silver have a margin call a little while ago, increase in margin. We also saw it again yesterday, which is, I think, a very big reason why we saw precious metals across the board sell off. Whoever's in silver, they're generally into a lot of other metals. And if margin requirements go up, they have to liquidate all kinds of different positions just to cover their silver positions and things like that. So we saw a lot of selling yesterday, based, I think, a lot on the margin requirement that was increased on the COMEX. But, when we look at a couple of these other plays real quick, like platinum, if you look at platinum, look at the big kind of volatility we saw percentage-wise. In like a 4-day window, it moved up 22%. In a 1-day window, it dropped 18%. And we still have the similar type of price action for palladium. And of course, just huge price action. Of course, everybody's talking about it. Everybody seems to be wanting to get into this space. Who is open to investing? I'm not saying all investors are moving in. I'm just saying those who are more or less open to the concept of adding and trading precious metals, they seem to all be piling in. And when they do that, we get into this back and forth price action. Silver is very exciting. I mean, I own a lot of physical silver. I now have kind of a warning flag in my head. I'm watching this chart like a hawk, along with other metals here, because I'm potentially going to be liquidating some of my metals at some point, depending where the market caps out. So people need to be aware this type of volatility is usually a sign that we're getting close to an end, but some of the biggest moves percentage wise do happen at the very end of a trend. That we could see silver spike and pop and really take off to 100. It's not about trying to pick or nail a top. It's about just following the trend. The trend is clearly still up. It had a big down day, but it's recovered and now it's back above the 5-day moving average. So the trend is still firmly to the upside. It's just got a lot of volatility in there now.
Whenever you see, just from a technical perspective, anything move up and down like this, let's just take silver and palladium as examples because you had both of them on your screen. And you've got these big red bars followed by a smaller bounce. What do you do with that information? Because on the one hand, you've got this continuous uptrend that's still intact. And on the other hand, you have this giant one-day washout, or maybe multi-day in the case of palladium, that was followed by some sort of consolidation and then a slight bounce up. Does that signal to you that the rally is over? Is that why we had that giant red bar, Chris?
I wouldn't say it's over. All it is telling us is like things are getting really wild. We've seen margin increase twice on silver. It just means there's a lot going on, and we need to be aware we could have a big reversal at any point. Now, you're right. This type of bar, when it gaps higher and then pushes up and then gets slammed down and closes below the previous day, that is like a bearish engulfing candle. The red body completely engulfs the previous day. It went higher, it closed below it. It's usually a reversal candle. Now, a reversal candle is only good for 1, 2, or 3 more bars after it. It doesn't, specifically mean it's the top for silver. The big thing with this inside bar, as you mentioned, this big red bar, is now price is going to trade sideways in here for a little while, and we need to see which way it's going to resolve. You're right. This is a bearish bar. Price might consolidate sideways here inside this range, and it could easily break down and have a bigger pullback before it maybe wants to go higher. And there's a really good example. Like if we just take a look at silver and use the Fibonacci extension here, we go from the low that we had over here. We had this big run up, this peak, and then we come down. And we talked about, maybe, I don't know if I talked about it with you. I probably did. But we had this target around 72 to the upside for silver. And that is the Fibonacci measured move, just based on this move up, the big correction, and then, of course, the 618 and the 100%. And once you hit that level, that's a level we locked in 20% gain. We were long an SLV trade with one of our strategies. We closed out a trade there. And then, of course, price got into this kind of blow off phase, this emotional move. And this is what happens when you hit these Fibonacci targets and then suddenly the crowd jumps in and creates this volatility. That means the price charts are painting a very clear picture of what's going on. And we did the exact same thing with gold. If you look back at gold and we just go back to this previous chart right here, it's just amazing how these charts, play out. We had the rally up and then we had this pullback and we carried this over. And so we got long gold for a quick trade with 15% right up to our target here. It had the hiccup and then it had the blow off phase before it went into a big correction. So the market, it's kind of rotating. We're seeing it happened in gold first. Now it's happened in silver, platinum, and palladium. Gold has had a pullback, a fairly sharp pullback for gold, but overall it's still, has a stronger chart pattern. But the charts are really strong here, saying that the trends are still up, but there's a lot of volatility. And people, I think, there's other two camps. There's other people who just buy gold and they keep it forever. And, they think the world's going to fall apart and all that stuff, and they're never going to sell it. And then there's other people who want to try to navigate it and trade it. And we could see a very big correction in 2026 in the precious metals space, which I think is going to be a huge opportunity. And I don't believe in holding something if the trend turns around. So I'll be looking to exit physical metals. I can always get back in later. But I think 2026 is going to be a difficult year for metals.
You already know why people hold gold. It's because it's real money. But what if your gold could do more than just sit in a vault? Well, that's where our sponsor today, Monetary Metals, comes in. They offer a way for you to earn a yield on your gold paid in physical gold. Through their leasing marketplace, you can earn up to 4% yield per year in gold. Instead of paying storage fees, your gold actually works for you. And because that yield is paid in gold, not cash, your stack grows no matter what the dollar is doing. Thousands of clients already earn monthly interest in gold and silver through Monetary Metals, and the numbers just keep climbing. So don't just hold gold. Start earning real gold on your gold today. Go to monetary-metals.com/Lin, link down below, or scan the QR code here. Put your gold to work soon. For traders like yourself, whenever anything gets more volatile, like in the case for metals, is that a scenario or a reason for you to get in or excited about getting into the market right now? Let's suppose you're out of the market because of this heightened volatility. Keep in mind the prices, especially for gold, for example, have been consolidating sideways for quite some time, and we're finally getting this up and down volatility that traders dream about. So how do you see it?
Yeah, when there's this type of volatility, like gold still has a very nice chart. I still think gold has got the target to reach around 51, 5,200, I hope, to the upside. But when we get this type of volatility, David, I really don't want to be holding stuff because I know it is a roller coaster ride and it could reverse. It's usually a sign of weakness. It's usually the market is running out of steam. There is a reversal coming. And the thing is, we're in this parabolic explosion phase in precious metals. And you just have to have your finger on the trigger. And I'm remaining long. But as you said, this type of volatility, I don't really like to be involved in stuff when it's like this because now it's the underlying trend is still up. We're just going to ride that trend until proven wrong, till that trend has changed direction. But you got to be cautious because this type of price action is pretty scary. And the monthly chart of silver is such a great way to look at what's going on. When you zoom way back in time, you get these giant spikes that go straight up and they usually don't end very well. And I keep seeing I mentioned, this the other day online, and of course, everybody's like, this time is different. This is, everybody says that each time. But to me, this is a very crowded trade. People have all moved into everything that says the word metals and mining into it. We're seeing just stocks and everything shoot higher. But I'm very, very weary of where this will be probably 2 or 3 bars from now, which is 2 or 3 months. January is a huge month for the equities market. If the month closes positive for the candle, we usually have a positive year for stocks. If it closes negative, it could be down. You and I, in our last talk, we talked about the cycles at play, the Benner cycle at play, that are pointing to precious metals and the stock market and the economy weakening and pulling back. And, if we were to just look at this is a monthly chart of silver that I kind of already drawn on. This red box brings us up to about 5,200 in gold. In the perfect storm, gold will move up to 51 or 5,200 in the next month or two. It'll be a very explosive move. Who knows where silver, platinum, and palladium will go? They could go very high. But then we're going to go into a big correction, potentially a 20 to 35% correction. Very similar to what happened in 2007, 2008. We saw that pullback. And then we start into another multi-year big move up where I think we see $7,500 gold and beyond. So I'm still really bullish on metals long term, but I think we're going to walk into this roller coaster ride in 2026 because when gold has these parabolic moves and breaks out of these ranges, just like it did in 2006, 2007, it's usually a warning that something bad is brewing and unfolding. And so gold is pricing in for that. That's why gold has gone from 2,000 to 2,200, 23 or 4,300 is because it's already pricing in instability, things breaking down. And I think there's some upside. I know you and I, when we talk about this, and I always reference 2007, everybody's like, well, this is nothing like 2007. And I fully agree. I think one of the best examples there's a couple of examples. You get into these bear markets. It could be the tech bubble. It could be the financial crash. Either way, price goes up or down in a very similar way. And it doesn't matter if it's because there was worthless tech companies or if it was the banking and the housing market blowing up. They're totally different, completely unrelated, yet the markets do the same thing. And I think a good example of this is when we look at the tariff chart here of what happened this year, the sell-off in February. You see this sell-off, it sold off. That was news. That was based on tariff move, right? Well, take a look at what happened with 2025. This year we had the tariff move, but look at 2020, the COVID. It's the same thing. It doesn't matter if it is somebody putting taxes on imports or it's a pandemic and people are dying and there's all kinds of world-changing things going on. Price does the same thing. It doesn't matter when somebody hits that sell button or the buy button. The market doesn't care what the news is. It's either people are buying from greed or selling from fear, and you just have to identify this. So there's no doubt the market condition we are in right now for precious metals is different. It always is different. And there's definitely some very strong signs that something big is brewing with lots of gold going overseas to Shanghai. We're seeing institutions. We're seeing, a lot of big buying, but by big firms and things, the central banks, right? So there's definitely something brewing. But again, you can't just buy and hope. People have been waiting for this move in silver, and a much bigger move in silver for like 20 years, 25 years since I got into this. So I like to take profits, play the charts, not the expectations or the news.
We're going to get Chris's outlook for all these assets. I'm going to ask him what his point forecast for prices of these assets that we've talked about towards the end of the interview. So stay tuned. Don't forget to like, subscribe, hit that subscribe button to get daily updates and see Chris on next time he's a regular on the show. Now, Chris, before we move on to the next asset class, people are buying silver in droves at Costco. I've been getting personal anecdotes of silver at Costco getting sold out. This is not an endorsement for Costco silver. I'm just giving you, just earshot whispers of what people are doing. I'm just saying, Chris, there's a lot of retail interest for the physical right now. How would you differentiate strategies of investing in the physical versus trading in the paper market? You mentioned you wouldn't stay in this market as a trader, given how volatile it is currently. But what about those people who just want to go buy a bunch of bullion at a Costco or wherever?
Yeah, it's tough. I mean, there's a lot. I just read an article about how strong the retail buyers are, right? So I believe buying, gold and silver right now. I mean, I think you've missed a good chunk of the move. You're in for a roller coaster ride. I think if you're just a retail investor, you're not betting the farm. You're not putting, huge amounts down of your life savings. It really doesn't matter. In the long run, precious metals should move higher and go up to the upside. I think buying right now, I think you're buying kind of at nosebleed territory. It might take still several years or a year or two to get back to where it is after the dust settles, I think in 2026. But I always there's a million different ways to trade precious metals. I've always been one for just buying brand name bullion. I don't buy anything fancy. I don't buy coins with all kinds of stamps on it and different stuff and pay all these big premiums. I just want ounces of the cheapest metals I can get of gold and silver. So I don't think there's anything wrong with going out and buying rounds. It doesn't matter where you buy them. I think if you're a strategic investor and it's a chunk of your wealth versus just going out to buy some for retail to be like, hey, I bought some rounds. It's a different game. I think you need to move. And as you look at these cycles, I mean, you really don't want to wait 20 or 30 years to get back to break even, or wait another, 10 or 15 years to get back to break even. And that's where potentially people could be buying right now. They might not see big returns for 3, 4, 5, 10, 15 years for all we know. And for Christmas, I know a lot of people gave silver rounds for Christmas and that aren't in the precious metals space. So that is one of the reasons why we're in this frothy, big volatility in the market. When the retail people are piling in, that's when we keep seeing these bouts of big selling of institutions and savvy investors saying, you know what, this is a little overdone, and they're dumping contracts or dumping metals positions to lock in gains, because usually the retail are the last people in.
On the S&P, you've touched on that. Any changes in the cycles that we've discussed for 2026? And I'll let you comment this however you like. We can take a look at, we'll revisit your cycles chart one more time, where I believe we're in stage 3. I wonder if we still are. And you commented to me offline that 2026 may be a year of several trend reversals. So walk us through the thought process. Tell us about these trend reversals and what we're looking for exactly, Chris.
Yeah. So, in a nutshell, I think you're right, David. I believe we're in this stage 3. Now, obviously, the indices have been pushing to some all-time highs over the last couple of years, dragging higher with the Magnificent Seven. But we are in this topping phase in the market here. And I do think we're going to see a bigger correction. And as you kind of mentioned, when we look at the cycles here, this blue cycle is the stock market cycle, and what we're seeing is precious metals across the board are shooting higher. They're the warning sign saying, don't trust governments, don't trust stocks, don't trust, the economy. You start putting your money elsewhere to protect it. So physical metals is a store of value. If you look at energy sector like XLE or OIH, they're trading up near all-time highs and holding their value, even though oil has been moving down for several years. Industrials continue to do very well. So I believe we're in this topping phase of the equities market. And when we look at the business cycle, which you and I have touched on before, the AI, this innovation phase, AI is like huge. Obviously, it's the biggest companies dragging the indices higher, even though the stock market is very, very sector rotation. One month, it's one sector's hot. The next month, a different sector's hot. It's not like all sectors are just going up and driving this market up. It's just little pockets here and there. And so this innovation of AI is dragging and stretching this stage 3 market to all-time highs and really kind of dragging or kicking the can down the road, but it's usually the sign that we're getting close to an economic peak. And right now we're already seeing this with the data centers. There's been the amount of venture capital money and investments going into the AI space makes every other bubble dollar-wise look like chump change. And so we're starting to see people not getting funding for data centers. There's all kinds of stuff starting to happen that things actually might be slowing. And so I think we're in this global expansion, but I do think it's about to stall out, and we're starting to get some signs, early signs that there's caution that we're going to start to fall. And usually once we get these signs of weakness, the stock market is already going down. And I believe January, February are going to be very difficult months, going to be choppy, and I think it's going to set the tone. And then once the markets go down, and then the bad news, which usually follows the stock market afterwards, that adds fuel to the selling and the fear in the market. So that's kind of where I think we are now. These are economic cycles. These obviously don't happen a month here, a month there. They can take months or sometimes years to slowly unfold. But I believe we're in this major topping phase, and it's just a matter of time for the momentum to stall out. I think in the AI space a bit more. And we'll start to get a little bit of more neutral and negative news that will kind of slow down the buying.
The trends that were already in place in 2024 and 2025, meaning strong headwinds for upward momentum, what technical and or fundamental trend reversals would need to be in place for that to stop? In other words, what needs to happen to either the economy or the markets or signals you're watching that basically would be a clear signal for you, Chris, as a trader, that the winds of upward movement are blowing the other way?
Yeah, I mean, if we kind of maybe zoom back on the S&P 500, we just go back to these previous bull and bear markets that took place. Usually you're going to have the market moving up, and eventually you need to have some very sharp sell-off, usually a 20+% sell-off. I'll just zoom into 2007 here a bit more. So usually you're going to have some big pullback, and then the market tries to stabilize. And as you know, David, the definition of like a bear market is 20% or more. And so the market did pull back in 2007 about 20%. And while people saw, even in 2022, we had a 20% correction, it was to me, a very controlled, a baby bear market. What happens after that is very critical. We come into this market condition where it puts in this pause, this complacency phase. People think, oh, we just had a bear market. That was 20% correction. And then it starts to move higher. And so what I'm waiting for is probably a 20% correction or more, and then probably a multi-month pause. And then if it breaks to the downside, that's when you go into a stage 4 decline, and where huge damage is done. This is where the layoffs, jobless came, everything starts to spike. All kinds of bankruptcies start to go through the roof. You can't get funding for anything. The mortgages become impossible to get. So we need to see this big sell-off in the market, and then some big pause. And then when it starts to break down from that, that's when things are going to get ugly. So price is always the number one indicator that you need to follow as an investor. And so I think for this market, it really depends on how things want to crash. If we were to just take a line here and say, okay, well, here's about a 20% pullback, we're going to need to see the market go into a very strong pullback, and then we'll have to see what it forms. It might form some type of shoulder here, and some type of bounce. It might just trade sideways and be very, very tame. And then it could start to break down and form another move. And then it could really go rapid. So it all depends on how much price pulls back, the chart pattern that it forms. And then if it starts to break down from there, then I'll be very excited in terms of buying inverse ETFs. When the market goes and starts to collapse that last, 30, 40+% potentially, that's when you play some inverse ETFs, because the market is just never ending selling, more or less. So those are the biggest things is price. We'll probably see most things start to sell off at some point. What'll happen is actually, if we go back to 2007, over here in 2007, we saw the stock market fall 20%. And gold ended up shooting higher. Money came out of equities, moved into precious metals. And that's what I'm thinking we're still going to see. We might have that big push where we see everything in gold hit 5,200. But then once you break that floor, once we see this selling in the equities and gold shoot higher, eventually when gold and precious metals start selling off and start moving down with down days of the equities markets, that's when I'm going to be, okay, you know what, I really think everything now is starting to get sold. The fear starts to grow. And so what happens is investors take this big hit and then markets trade sideways for a couple months and they start to get scared. And then as soon as gold and their other investments start to move down, they're in shock and they're worried it's going to do the same thing as the stock market. So eventually gold will start to sell off with the stock market. And when they both start moving down together, that'll be the sign going, okay, I think the move is over in metals. I think we're going to go into a stage 4, but stage 4s don't happen until way over here. You need a lot of damage done. And by the time we get over here, we're probably going to start to have some pretty bad news. We're probably going to have something blow up. We're going to see all kinds of weird things happen. Who knows what it'll be and what they'll label the next bear market, the title will be the tech bubble. It'll probably be the AI bubble or something, right? But that's kind of what I'm looking for is price first. And so there's a lot of damage that needs to be done.
How many red bars do we need to see? How many down days do we need to see before we can confirm a bear market and not just a technical correction? Or is it a specific level that you have to target to confirm this bear market? How does it work, Chris?
Yeah, so there's a few different ways. When you're looking for like a bear market phase, I generally like to look at a good example. Here's this dotted line, this moving average. So I like to look at the daily chart. It's great because you can zoom out very far, but it gives you a granular, 5 bars per week. So it gives you a granular look. This moving average here that I like to use is the 150-day simple moving average. And generally, it's pretty straightforward. If it's sloping up and prices above it, you're generally in a stage 2. When price is below it or it's flatlining or sloping down, then and it's mixed, then you're generally in a stage 3. And then when it's sloping down and price is naturally below it, then you're in a stage 4. So it's a very passive way. It's not great for timing when exactly everything happens, but it definitely gives you an idea of how the markets are stalling out. Are they starting to lose momentum? And same with the 50-day moving average. The 50-day moving average is pretty good. And, you can usually start to see if we have, 20 or 40 days, which is 2 trading months, more or less, 1 to 2 trading months of sideways or lower pricing, we start to see the 50-day move down. And it's a pretty good barometer. If the 50-day is sloping down, you really don't want to be involved in the markets. It's showing some pretty mass weakness. And of course, if the 50-day moving average ends up below the 150-day, then it's kind of like a death cross. A lot of people use the 50 and the 200-day. I like the 50 and the 150-day. So if the 50-day crosses below it, then you probably don't really want to be holding stocks because you have the long-term trend is down and the short-term trend is down. You don't have any trend in your favor, and you got to trade with the trend. So you better flip the script and start focusing on things that go up in value while the stock market falls. A lot of people play the VIX. A lot of people play inverse ETFs. There's a different ways you can play that as it unfolds.
All right. I want to talk about Bitcoin now. Let's move on to Bitcoin. $87,000, $88,000 now on the 30th of December. And the longer term trend has, depending on what time frame you're looking at, but many people on my show and some others have been calling Bitcoin as a leading indicator for stocks. And, there's all sorts of thoughts and reasoning behind this, or perhaps people who dispute this have their own reasoning as well. I'd like to get your take on whether or not Bitcoin typically leads stocks, because what you've seen here is a fall from $125,000 to $88,000, which is not insignificant even for Bitcoin over the last 2 or 3 months. So walk us through the trends that Bitcoin is seeing currently, and second, whether or not these trends may translate to other markets like stocks.
Yeah. Yeah. So let's look at this from a big picture standpoint. If you look at this from a long-term investor, you could just say, okay, well, Bitcoin has these series of cycle lows. So technically right now I see Bitcoin at a very critical cycle low. The long-term trend is, it's making a series of higher lows. It's also making a series of higher highs. That's the definition of a uptrend. Now we do see this green line, which is the 150-day moving average. It's actually starting to slope down, and prices is below it. We haven't really seen that, through this phase. So that is an early warning sign saying, okay, well, the 150 days sloping down. It's had a very sharp correction, 35%. The 50-day moving average is also below it, very strongly below it. So you could say that, at this point is maybe putting in a top, but again, I'm not a fan of this. I believe we're going to see it break to the downside and sell off. And I think probably the weekly chart, when you get rid of some of the noise, the weekly chart actually, I think, shows the chart pattern very clearly. If we just zoom in here, this little pennant formation actually points to a dramatically lower price. If we just take this move and to this pennant, it's actually showing around $48,000 per Bitcoin. So you got the move down. This pennant formation is known as a pause. It's a bearish pattern. Whatever this first half of the move is, you're going to have the second half usually around the same amount. And of course, that is going to pierce this low. We're going to see this low get broken. We're going to see probably this low get broken as well. The market loves to break these standout, very significant lows. And of course, this is going to catch a ton of people off guard if that's what the charts are pointing to. Now, so Bitcoin has big mixed signals. I wouldn't be touching it right here. I actually would be leaning more to it breaking to the downside and collapsing than I would be accumulating it. I know a lot of people keep saying they're buying it. This is an opportunity, but I mean, the space is really difficult to navigate with analysis because everybody has this like natural bullish bias on Bitcoin. Everybody pumps it up, and I try and just give it how it is. The long-term chart is up. We're at a cycle low, but the cycle seems to be stalling, and there isn't a clear signal on it. If anything, I'd be betting to the downside. So that's my take for 2026. And I don't know if maybe it's going to lead the stock market. I've never really looked at it as a leading indicator. I kind of see it more so following the NASDAQ a little bit, but the fact that it's floundering, like it's just refusing to get a bounce here, is not a good sign. So if the stock market has been moving and drifting higher and it's been trading sideways, what happens when the stock market goes down? This thing is going to free fall. So it's not a good looking chart, in my opinion.
Okay, can we move on now to the dollar and treasuries, maybe treasuries first, and get your take on yields and how that may or may not translate to the dollar?
Yeah, I mean, I like to look at TLT for the overall kind of the bond market of what's going on. We're clearly, the bond market is still in a downtrend. It's trying to carve out a bottom, and it looks like bonds actually still might want to move a little bit lower. This is a difficult time to get into something. Typically, when big volatility kicks in, these this is a big kind of topping phase. And I believe now we're kind of more so into a bottoming phase. It's a time where you carry a lot of risk. You're uncertain. You don't know which way it's going to go. You don't know if this is a pause before it goes higher, or if this is a pause before it goes a whole lot lower. So I don't have clear direction on where bonds are going. We need to let it build more of a base and start to break out. And just like the stock market needs to put in a big top and break down significantly before we can clearly say, oh, we're in a bear market. Well, bonds are in a bear market and they're trying to carve out a bottom, but we need to see a significant rally in bond prices to break some highs and start to make some higher lows and higher highs before we can get bullish. And so obviously, if we see TLT, we see bond prices go up, that means yields, interest rates will be going down. And so at this point, I'm pretty much neutral. I think we're going to see the Fed kind of kick the can. I don't think we're going to see huge moves in the interest rates, I think 2026, we will start to see movement. I think we're going to see weakness in the market and the economy. Rates could start to come down, and then we'll start to see bonds come to life. But I think the Fed is pretty neutral. I don't think they're going to do a whole lot at this point until there's a lot of pain on Wall Street, until there's a lot of pain in the general public, and potentially like unemployment or bankruptcies start to spike. I think that's when we'll start to see rates pick up speed to the downside, and I think we'll see bonds start to move higher.
The fact that the 2-year yield is expected to fall as the Fed continues easing into 2026. How do you play that as a trader? Do you look at that?
I don't look at that. I don't have the 2-year. I got the 5 and the 10-year, but no, I don't trade based around yields. So it's not something I focus on.
All right. And the dollar then, the DXY, tough year for the DXY. Trend reversals in the DXY at all in 2026, Chris?
I do think we're going to see it it's either going to trade sideways and hold its ground, or I do think we're going to see it have some type of rally, potentially a very significant rally. Right now, it's doing the same type of thing. It's trying to carve out a bottom, very similar to TLT, the bond market. I believe it's carved a bottom. It has put in, if we look at the chart here, it has put in a higher low at this point. It's also put in, it's got a high, it's got a higher high. So it is technically channeling and trending up. It has definitely pulled back deep into a support zone. It needs to find some traction here, but I do think we could see the market, we could see the dollar have a significant move up, and that might create some serious headwind for the precious metals space as well. So if the stock market does start to sell off, I think we could naturally see the US dollar start to strengthen. We saw that in 2022. We saw let me just go back to the daily chart here. When we go back and look at 2022, the stock market sold off and the dollar shot higher. So I think we could see the stock market sell off and the dollar move up. I think the dollar index could get back to 109. I think it could get back to 114, which I think the majority of people don't think is possible. And everybody's expecting precious metals to skyrocket, the dollar to die. And usually that's one of my key tools is we have these sentiment tools to help us gauge. I'm like, okay, at a fairly significant low and for the dollar, and people hate it so much that I think we're going to start to see it move higher. And of course, everybody loves precious metals, which means, and we're seeing the volatility and the general public start to move in and buy it at every corner store. That is usually the sign that metals are going to top. And so when you feel really good about something, that's usually when you need to be the most worried. So I follow when other people get excited, I'm usually looking for the opposite move that everyone else is.
Okay, Chris, we promised the audience we would give point forecasts before we take off for the new year. So let's just go in order of presentations. We started with silver and gold. I've heard silver could go as high as $100 in 2026 before a reversion. The fact that it's seen significant resistance at 50, sustained above 50, and then now we're seeing obviously resistance at 80. I wonder how likely 100 is. Now, of course, the higher it goes, the more likely $100 in triple-digit silver becomes because the percentage gain is smaller. The elusive $100, what needs to happen for the price to hit that target this year, Chris? If it will. Maybe that's not your view.
Well, yeah, it depends on how you look at it. I do think silver could spike dramatically higher. I mean, when you look at the log scale and this giant bull flag pattern, I mean, this isn't a pattern I've ever really showed anywhere because it does point to some crazy high pricing for silver. So based on this run up from the 2000 low and the big pullback, it's really just breaking out of the high that we saw back in 2011. This tells us kind of, that upside target. It's 57 was the upside target for it. And then we had to drop down to intraday charts, which you and I did in a previous video that pointed to around 72. Right now we're in bubble phase, so silver can pop and take off, and I do still think we could see one big push, and silver could spike potentially, past 100 very quickly. I think it could be short-lived. I think it'll be an emotional-driven move. It'll be pure FOMO. Everyone piles in to get involved, and then it'll probably reverse and come back down. But I do believe in what you said and some of your other guests saying, once it does top out and pull back, I do believe it's going to hold above 50. I think it's broken that threshold. And so now I do think it's going to naturally, it's going to become the new floor for silver. maybe down to 40 to 50 will be the new floor, which is great. And it'll build a base. And then I think over time, when it starts to break out, then we'll be off to the races to 100 plus for silver. I guess, again, I'm really bullish on metals. It's just short term. I'm getting a little nervous, and we just have to let this bubble burst. And then we're just going to have to digest and wait for the next foundation, like the next base like this to build out. Does it take 6 months? Does it take 5 years before it starts that next big run? We don't know. But the volatility and the crowd psychology of people moving in is telling us we're on the last few bars when it comes to the monthly chart. We probably have 1 or 2 bars left, and we're going to see the metals probably top out across the board for potentially a year or so.
Gold, similar question for gold, but gold has not had this kind of parabolic move in recent weeks, but similar question, Chris.
Yeah. I think this chart kind of shows it. I still think we could see gold move up to 51, 5,200, and then I think it's going to pull back. I think that's going to happen in 2026. The pullback might be short-lived. It might only be 3, 6, 9 months, and then boom, we're back off to the races and heading higher. But obviously, if it does pull up to this 51, 5,200, it will have a really steep correction, I think, a very sharp one, and it'll be a huge opportunity to either buy more or to get back in, depending on if you sell, once it starts to peak out here. But I do believe we're going to see gold try and grind higher still for another month or two. And then I think we're going to see a very sharp pullback. But I think by the end of next year, gold will already have bottomed and same with silver, and we'll be moving higher. And I think it'll be a great time to get into, I think, miners. I think that's when miners are really going to explode. They're going to build a base here over the next several months or 2026, and then I think we're going to see a very big move together. So I think by the end of next year, the precious metal space will be very exciting, similar to what we saw in 2007. It's fairly short-lived correction, and then boom, you just head off into a multi-year rally. And you'll want to own probably a lot of metals, a lot of miners, and probably uranium and whatever the new big sector, which will probably be like data centers and AI and robotics, during the next major bull cycle.
And flipping the script now to stocks, we've talked about stocks a lot. Let me frame the question a little bit differently. At what point would a rally in the S&P 500 or any of the tech stocks for that matter convince you that the bull market is not yet over? In other words, how much further can we go before the trend reversals? Or on the other hand, if it continues to go higher, at what point will you change your mind about a reversal altogether?
Yeah, those are good questions. So as bearish as I am, it doesn't mean we are betting on the falling market. When you look at our weekly chart of the S&P 500 here, we entered, this is back in 2023, it entered into a new bull market. We saw a big move up. Then we had the tariff market saying move aside earlier this year. Then we got back into the market. We are still in a bull market. It's just, to me, it's not a raging bull market in terms of all the sectors are going bananas and exploding and everything's popping and breaking out. What we're seeing right now, so we're in a bull market. And the thing is, it's not a full-on sector, broad-based rally. When we're in a brand new, fresh bull market, we tend to see sectors create bullish, sharp patterns, and they break out and they run. But what we've been seeing for the last several years is a sector will have a nice chart pattern, and then it'll break out, and then it'll fake out and reverse and crash. And so you get into a trade, it works for a few days, and then just falls out of bed and then collapses and drops 10, 15, 20%. Sectors have been doing that for a couple of years. And that's not the sign of a healthy market. You want the majority of sectors to be moving higher. When they have a breakout, there's big volume behind it and price runs, and you see 20 or 30 or 60% moves in these sectors to the upside that follow within a short period of time. But we're not getting any of that. So if we start to see all sectors really start to take off and break out and run, then I'll be like, you know what? I think we're rejuvenated and we're still in a bull market, but I think we're starting kind of a new wave that this bull market could have another big move. And, the market does have this pattern right here on the weekly chart for the SPY. It has been consolidating for a couple of months, a few months. The longer something trades sideways, the bigger the move it can have. So there is potential for another nice move. And if we do get another push higher, the question is, do all the sectors start to break out, or is it still just precious metals and AI? Or, AI is losing its momentum. It definitely doesn't look good. The Magnificent Seven doesn't look good, all of that stuff. So it's going to come down to what the stocks in general are doing. But for me to change my mind at this point, I mean, I still feel like a big bear market is coming, but really the key is to follow price. And that's the biggest thing, is we're still long the markets right now. Yeah. We're long gold, we're long equities. And as bearish as I am, the trend is still up. I'm just making sure you're prepared, because when a bear market hits, it wipes out most people's retirements, usually within like 6 to 8 months, right? And you work your whole life to lose it all. And that's what I try and protect people from, is you just always have to be prepared, but ride the bull. Like that's it.
Okay, then final question for you, Chris. The most bullish and most bearish assets you're on for 2026.
The most bullish and the most bearish. I kind of feel like it depends on what you consider. So for example, I think Bitcoin will have a very precipitous fall if the market breaks down. There is a lot of room for Bitcoin to really collapse percentage wise. It'll be a fairly big move. The other one that I'm pretty bearish on is the Magnificent Seven. I believe there has been a lot of money, a lot of general public, a huge volume going in here, that when it starts to sell off, there's going to be a very precipitous and a quick exodus, and we're going to see a sharp sell off in price, where it's going to move in a big way. It's a mass psychology play. It is not only small investors, but it's big retirees. Like the Magnificent Seven in AI has sucked in everybody. And you can see that with the amount of funding going into everything AI, right? So when that tide turns, the once, darlings that everybody wants are going to become probably one of the most hated, and they'll be like, holy crap, like things could fall 50, 60, 80%. Some of these tech companies, doesn't matter what their earnings are, these stocks can still get hammered and fall and become oversold, become actually undervalued because of this type of scenario, where people just keep taking losses. And it's a steady stream of millions of investors around the world every day, a different batch hitting the threshold of like, I can't take it anymore. They call their broker or they sell their position. So the Magnificent Seven, I think, is going to have a really precipitous fall and reset the financial markets. Okay,
great. Well, Chris, thanks so much for your contributions in 2025. We'll look forward to more in 2026. Where can we find you, and what can we expect to learn from you when we do?
Yeah, sure. Well, the best spot to go is go to my website, The Technical Traders. And my whole mission here is to help you avoid bear markets, protect your lifestyle, sleep better at night. And that's what I do, more or less. I help people if they've missed the rally. I help you stay in the rallies. I help you not have to worry about a market top, because we can identify when things reverse and turn around. So this is what I do with this newsletter, is I simply share my portfolio, my strategy. We take the same trades. I have 5 to 12 ETF trades every year, depending on how many waves roll through the stock market, new cycles and trends. And we just navigate the markets in a way that's really slow and steady. It's a bunch of first, second base hits. It doesn't matter if you have a financial collapse, you've got flash crashes, you got COVID, you got a 2022 bear market. We just continue to grind our way higher. We have high average returns. We have very low drawdowns. We're never going to like blow up our account with this strategy, which is the nice thing. If you're close to retirement or retired, the last thing you want to do is get hit with a bear market. We don't have to worry about all that. And I have a special going on right now, which if you were to go to the website, we're actually giving away free physical gold to every subscriber who joins before midnight on New Year's, so tomorrow. And on top of that, you get a 1-hour video call. We can get on a call, a group call. We talk about the markets. We could go through all kinds of different things. And so we've got a special package that if you get our package, you get all of our services, our hottest sectors, our band strategy, you get our technical investor strategy, which the technical investor strategy tells us like this. It tells us when we're in a bull market, when we're in a bear market. When we're in a bull market, just knowing if the tide is going up, if you should own equities, or if it's going down and you should step aside. We break it all down from long-term trends all the way to short-term sector trading. And we even have options as well. So that's what we do, and it's at our website. And we've got a special right now.
Okay, excellent. Thank you very much once again. We'll see you soon in 2026, Chris, and appreciate everything you're doing for us. See you
Thanks,
soon.
David. A pleasure. Thanks for having me, and have a great New Year's.
And thank you for watching. Don't forget to like, subscribe, follow Chris in the comments down below or the description down below, and Happy New Year to you as well.